All right, so when you're ready.
Fire away, man. I'm ready to go.
Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. My very special guest today is Dan Ferris. He's the editor of Extreme Value. He's a great value investor. We're going to talk to him right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
G'day, Dan. How are you?
Oh, very well. Nice to see you, Toby.
Yeah, likewise. Good to see you again. Enjoyed chatting to you last time the tables were turned. I really wanted to get you on the other side of the mic, find out what you thought. I've listened to a few of your podcasts where you've been on the other side too. One of them with Med Faber that I really enjoyed.
Yeah.
I just wanted to get an idea of your philosophy. There's quite a value's a very broad church. There are some guys who find themselves at the growthier end, and then there are guys like me who find themselves at the what I call the deeper value end. How do you kind of characterize what you do?
I would say that I've made a progression probably from the deeper end more toward the growthy end over the years. But you know something? That deeper end, it's still there for me. I still look there because I found over the years, I found a few things that were so interesting and so cheap that I couldn't resist them. So maybe I'm a hybrid. And that original idea, which I think it really came from the special situations section of security analysis, right? That original deep value idea, that will never leave me, I don't think. But I do think that today, it's a great idea, and it's always been a great idea to try to find a business that's earning $1 now and that you think can earn 10 or 20, down the road. It's part of the appeal to that to me is that I think it's relatively easy to find something that is a great business. It's something you can actually do. It's a handle that you can have control of. You can say these are great businesses, these are not, and you can really. I think an individual investor especially can learn that probably better than they're going to learn a lot of other stuff individuals try to do, or individuals or institutions, right? People get into these predictive strategies where they're trying to figure out, which way the market's going to go up next and all that. It's too fraught with peril, and it's too much potential to be fooled by randomness.
Yeah.
I think the average sort of naive investor likes to look at price charts because it's available. It's availability bias, right? Whatever is the easiest data point that's in your face all the time, that's the one you think is important, right? But it doesn't turn out that way in reality, and you get fooled by randomness. And I think what most people do when they think they're doing technical analysis, it's sort of like seeing Einstein's face in a cloud as it rolls by or something, or, you see faces in the bathroom tile or something. It's more like that than it is anything sophisticated. And I'm not saying there aren't sophisticated people doing technical analysis, but I'm saying the overwhelming majority of individuals are not really doing anything like that. So what they should do is learn to say, something, let's just say Microsoft is a fantastic business. It just gushes cash. It doesn't require a lot of capital. There's over 1 billion people using Office, and some of them hate it, but they must use it. Must continue to use Office. Office is embedded in our lives deeply than a lot of products. So I think it's probably always going to be a pretty darn good business, and I'm pretty sure it's going to be earning more in 5 or 10 years than it is today.
So is that your definition? How do you think about what's a great business? How do you know it's a great business?
So it's a subjective thing. Let's not try to reduce it too much to a formula. But in that context,
that's what we do around here, Dan. Reduce it to a formula.
We reduce it all to a formula. So, financial markers, right? Cash flow. What's the value of a business, right? All the cash you're ever going to take out of it for its whole life, discounted back to the present, right? That's what it's worth. So cash flow, excess cash flow, the ability to generate plenty of that and in a growing stream over the years, pretty important. and then there are things that lead to that, right? So, consistent margins. They can even be thin margins, right? Like Costco, I think the net is like consistently like 1.5% or something, but it's consistent. And that consistency over time, that's the economic anomaly, right? Because in capitalism, in a market environment, profit margins are winnowed away by competition. So when it's consistent over a long period, it's a clue. Can be a clue, strong one. Good balance sheets, right? It's just prudent, right? You don't want to get into a highly levered kind of a situation that can blow up on you. And in general, like some companies can be good at buying back shares. Most of them stink at it. I think the benefit of what I would call shareholder rewards, dividends and share repurchases, I'm telling you, this sounds really cynical, but I think one of the primary benefits is that it takes money out of management's hands, Because let's face it, most businesses aren't Berkshire Hathaway. There aren't 75 things that you could potentially invest in. There's like one or two, And if you get too far afield, you're probably Peter Lynch's old thing, diversification, right?
Yeah.
You're probably doing that with most businesses. So by all means, get the cash out of their hands. I think over the long term, you find a really good compounding business. Getting the cash out of your hands is even more important than, getting a great deal when they buy back the stock, And then the final thing, I look at returns on equity, which I think is a good number for equity holders. There are other, and in general, just that return complex, ROA, ROIC, you want to consistently see those at pretty good levels because, basically that return on equity and these returns on the capital invested, it's like a bank account, right? That's, you leave money in your bank account and it compounds at that rate. And you find one that does a substantial rate at all the money that stays in the business, and it can be a real humdinger, what Charlie Munger might call a Lollapalooza. So those five markers are pretty important.
How do you think about valuation? So the finding those things can be, it's not, I wouldn't say it's easy, but it is, you can find those things in the market. The challenge then is finding them at a reasonable price. But how do you know when you're looking at something, is this a reasonable value or is it not?
Okay, this is a big topic for me because I learned to flip this. The old way of discounting cash flow, right? You sit down and you project. You predict, basically. You say, we're going to earn, they're probably going to do, this much in year one and this much in year 2, 3, 4, 10, and then you put some kind of terminal value on the end of it. But you're basically predicting the future there. And that has always bothered the hell out of me because I don't know the future.
What's the solution?
The solution, I believe, is I got this from reading a book called Expectations Investing by Michael Novison and Alfred Rappaport. You flip the thing on its ear, and instead of predicting the future and discounting that and arriving at a value and trying to buy at a discount to that value, what you do is you plug in those inputs for the future to equal the current share price. So you're basically asking, what is the market saying at this share price? And if the market is saying Starbucks can't grow for another 5 or 10 years, I'm going to call BS on the market, and I'm going to say, I think it can, and buy it. And that was an example from the Extreme Value newsletter. We looked at that and we thought, this is absurd. Zero growth for Starbucks is absurd, and turned out to be a pretty good deal, I think. So it's that. It's flipping the process around and doing the plug-ins for the future cash flows, and it's really revenues, operating margins, and free cash flow, operating and free cash flow, and then seeing what that says about the current share price. Sometimes it says the market is expecting a lot. Sometimes it's, all the expectations are in line with everything management is saying and everything, that people expect in general. And then sometimes there's pessimism built into that, and that's when we pounce.
I like that. That makes a lot of sense.
It's so easy, doesn't it?
Yeah, easy to put into practice.
Yeah, it's not.
When you're constructing your portfolio, do you give any thought to, we've got a lot of exposure to this sector or this industry. We don't want to add something else here, or do you think if it's a good enough business, I'm going to stick it in the portfolio?
Two things on that. Look, if things get really dirt stinking cheap, I'll be overweight all day long. And then, we'll trim if we're right. You can trim on the way up, and then you reduce your exposure. But in general, we do worry about exposures to a lot of things. Real exposure to commodity prices is one that you want to watch. Exposure to anything that, if something pops up in the news and we need to take a look at it, we will. You can do that on the fly sometimes, and you're okay. And we try to think about these things as much as possible before you sort of pull the trigger, but you can't think of everything. So you do have to worry about what you're exposed to. But I will say this about that. I've learned something about the value of survival. I think a lot of people, and the basic institutional model is like the 60-40, stock and bond portfolio. Well, I think people are optimizing too much around a Goldilocks or a really good economy. And they're not thinking about survival. They're not thinking about their own uncle point, right? And that screws you up. And so to be truly diversified and really sort of worry about these exposures, I just haven't found anything better than a big chunk of cash to diversify an equity portfolio. If you know something, man, turn me on to it.
No, I don't.
Because I can't find it.
So what's a big chunk of cash? What's your rough definition of that?
I'm talking like 20%.
Yeah.
That's a pretty solid chunk. And it'll make you feel pretty good when your equity is down 20 or 30%.
So you're trying to hold something like that through the ordinary course, and then maybe when you get, like we've just gone through, you're trying to put a little bit more of that to work, pick up some of the bargains as you go through that.
Absolutely. And after a year or two to rebalance back to 20%, yeah, sounds good to me, because I'm not worried about beating the market. Really, I know that sounds crazy. If my readers are listening, they're going, "You're not." Hopefully, with everything we just went through, they'll kind of appreciate the viewpoint a little bit more. People tend to do that, but I hope they remember it. 5 years from now, when the market's back up.
How do you think about concentration, diversification, things like that?
Diversification for me, it's like, are you truly diversified if you have something like cash versus equity? That's really it. But as far as the concentration, I assume
just how big is a big position?
Yeah. So how big of a position? Okay. So for me, a big position like pedal to the metal is probably 5% of the portfolio. And these are things, I guess, over the years, I'm trying to think of things we recommend in the newsletter, because I'm a shameless plugger of my newsletter, I guess.
Do it. That's what this is for.
So maybe, we did have, I think we recommended 5% on things like, Berkshire Hathaway, and at one point Walmart, but not anymore, and Constellation Brands, and, just big franchisee cash gushers like that with, good brand names to them. And what I think people might call an economic moat, I try to stay away from that, because it's like this thing that, well, there's a moat, so we don't have to worry anymore. Moats are in motion all the time. Is the moat growing? Is it shrinking? Will it disappear? Those are the real questions, not is there one or isn't there one. Is there one? Sure. Okay, yes, but what is it doing? What is it getting bigger or smaller? So, and the nature of the moat too, like if you look at Facebook, this is like the greatest advertising platform that's ever been invented, right? You're constantly telling the world what you're in love with and where you are and what you're doing, and that's the best way to sell things to people. Um, but there's this tobacco-like quality of social media.
Yeah.
You know? And I do worry about that a little bit. And we saw some of that. I was worried about Facebook, and I forget when it must have been 2017 at our annual Stansbury meeting in the fall, and then the next year, I guess it was maybe that July 2018, I want to say July 26th or so, and Facebook lost, I think it was 19 or 20% in a minute because people fell really way out of love with it, and the results were reflecting that. I mean, it's done well since, but I worry about things like that.
I have these thoughts about Facebook that it's a little bit like there's a little bit of fashion to it, in the sense that the new generation that comes through doesn't want to be on the same platform as the olds are on, which is why you see I think that's why Facebook came about in the first instance, because you had to be at one of these universities. It was a little bit exclusive. You could get in. So everybody wanted to be in. You had to get an invitation, and then it grew away. And then the next generation don't want that. They know that grandma and mum and dad are on the platform, so they want to be on Instagram. Now it's TikTok. It keeps on going like that a little bit. I think they can keep on buying to kind of stay there and maintain the position. But I wonder how strong it actually is, that network.
I know, and I mean, for me, I won't talk about you, Toby, but for me, I'm like, well, I'm probably an idiot for not owning it, right? Because it just gushes money,
Yeah.
just gushes cash. But you can't own everything. You can't kiss all the girls at once, right?
As much as you might want to. I still think when I look at something like Google too, Google still seems to have a bigger share of the advertising market, and it doesn't seem to be doesn't have quite the same ick factor. It's got that.
Yes.
Everybody's got a Gmail account, doesn't even think about it. Everybody's got that connected to their YouTube account, doesn't really even think about how much Google is really there at every stage of that process.
Yeah, it does. That's right. People don't realize it kind of flies under the radar. And not only that, but as Whitney Tilson has pointed out, the optionality in things like YouTube is incredible. I mean, YouTube is a huge, huge platform. It's like bigger than Netflix.
Right. And they don't pay for content up front. They pay for
Right.
it on
Yeah.
the back end, and not much.
That's right. There's no capex for generating a new hit series, right? It's pretty cool. So, yeah, I agree. I like Google as a business better than Facebook for sure. I think Google and, of the big fangs, like, no matter how you slice it, Apple's still a one product company, right? It's like, I think
Yeah.
it's on the 50s. It used to be 2/3 of the revenue. I think it's now like 50 odd percent iPhone. iPhone's like more than half the revenue still. So, oh man, that's tough. You got to, as that changes over time, what becomes the bigger piece of that mix? I don't know. Um, but yeah, Google and Amazon too. Once you read the first Amazon shareholder letter and you look at everything he's done, it's like, wow, nobody ever consistently does what they say they're going to do.
Yeah.
And what he says he's going to do is fantastic. Just focus on real economic value creation. Don't worry about earnings per share. Worry about cash generation, and treating customers extraordinarily well, better than what other people are doing. That's a winning formula, and he's done it.
I guess that's what happens when you get a DE Shaw guy. You get a finance guy who becomes an entrepreneur. He kind of knows that you don't pay taxes, just recycle it all in the business, grow it really big.
I know, and I remember in the beginning, all the value guys were screaming, "Oh, he loses money on every book he sells. He's a hedge fund manager." It was just like all the strengths were seen as weaknesses, but we sure all get it now, don't we?
Yeah, I freely admit that I was one of those guys. Didn't get it until maybe 5 years ago, and then it's too late, right? Yeah.
Yep. Guilty.
How are you sourcing ideas? How do you come up with your ideas? Are you running screens, or are you just sort of a little bit more open to reading something and that's an interesting business? How does it happen?
Um, I'm supposed to come up with some really cool answer here, but the truth is, I just like to maximize the opportunities for bumping into these things. And I just want to take in these days, I want to take in as much material as I can. So I will consciously, this is the systematic part, I guess. I'll consciously go to like Wall Street Journal, Financial Times, every kind of publication or website that I can. And I'll always click on like, there's usually like a company tab, companies or businesses or something like that. And I just want to see what's around. And I'll look on. I found this one billboard recently. I can't even remember what the heck it's called, but it's like hedge fund managers talking about stuff. And I'll read any kind of a newsletter just to see what the person says. I'll read anything at least once. But it's just a matter of maximizing opportunity to bump into something new that you haven't heard of. Plus screening. I love screening. I like to do screening. Um, I do acquires multiple screens. I do.
Appreciate that.
Yeah.
What about sort of a quality type screening? You just look. Let's show me all the stuff with the highest ROA, ROIC, ROE. Is that one of the things you look at?
Yeah, I just want to see what comes up, because no harm, no foul, right? You run a screen and you get all this stuff you haven't seen before. And one of the things I like to do every now and then is mostly I screen for really good balance sheets. That's like a part of all my screens. Every now and then I think, maybe I am really missing something. So I'll take that out and just see what comes up. And I can't honestly say, it's been a long time since I found something. I think the last time I did away with that was when I found Prestige Brands Holdings it was like right around the crisis, right around the bottom of the crisis in March or April 2009. It's like, wow. And it was like, 5 times free cash flow. And this business they don't do manufacturing or even distribution. They just own the brands. It was
That's
like
great.
a royalty. Yeah. Back then it looked really cool. It doesn't look as great to me now as it did then, but I thought, wow, nobody wants this thing because it's got 300 million of debt and the market cap is like 300 million,
Yeah.
And it came out of private equity and people feel funny about that sometimes.
What does it own? What are the prestige brands?
It's stuff like wart remover, like Compound W wart remover. And it's changed over the years, but back then it was Compound W wart remover and Murine eye drops and Spick and Span cleanser and another type of a cleanser and some little products like that. And they reported ACVs. I can't remember what ACV stands for, but the idea is that like a 90% ACV means this brand is available in 90% of all the places where they sell this type of product. And their ACVs were like 60 and higher on everything, and some 80, 90, 99, I think one of them. I think Compound W was like 99 or something at the time. And I thought, wow, it's Microsoft Office. You can't avoid the thing, right? So.
Yeah.
And it's gushing cash. It's a low capex business model. I'm all in, and we recommended the thing and got I think it was close to a 5-bagger or so out of it. Yeah, it was 400% out of it, so it worked.
So it's those things you're looking for. Basically, for prestige brands, it was like if you think of tissue, nobody calls them tissues. Everybody calls them Kleenex. It's like almost the thing when you want wart.
Yeah.
You don't want wart remover. You're looking for Compound W.
Yep.
It's the thing that's top of mind.
Yeah, and it's interesting that you named Kleenex, right? Because that's the classic example, but it doesn't mean you want to own the company that makes Kleenex, right? Because people think anything that looks like that is a Kleenex.
Right.
So, it's got to be more like, like Office or even Coke. Coke still is, if you think sodas are a good idea, Coke is still one that a lot of people like to drink.
Well, let's talk about Coke. Do you have an opinion on Coke? Because it looks expensive last time I looked at it.
Yeah, I'm not terribly wild about it because it maybe it can't grow so much anymore, and maybe the these things are fantastic ideas, can be fantastic ideas for decades, and then they can become mediocre ideas. And I know the one good thing I know about Coke is that if you have any kind of a drink product, you can't get a better distribution network to be part of than Coke. So there is a chance there that if they can acquire something, if there's a next hot type of a beverage that I'm not seeing, and Coke acquires it and shoves it through that system, drinks cannot be like, it's not virtual. It has to be delivered to me, and I have to put it in my hand. But for beverages, we kind of like things like Starbucks and Constellation brands and stuff. They're more addictive.
You ever take a look at that chart for, it's Monster now, but it used to be Hanson's Natural Beverages?
Oh, sure.
It's famous, right? My mother-in-law had the Hanson's Natural Beverage way back in the day, and like always had them there. And I went and looked at the chart one day, and the chart was up 50,000% or something by the time I looked at it. And I was like, whoa, that's I've missed the move in that one. I don't know why. And then of course it's proceeded to go on. It's gone up 5 times or something since then. Just unbelievable return in that thing.
Yeah, those are interesting situations, right? Because I'm convinced that maybe there are people who can find them and know how to look for them, but I think I'm only going to luck my way into them. I lucked my way into a multi-bagger on Constellation. I lucked my way into a multi-bagger on Prestige, just because I was looking for some other characteristics and the brand name and stuff. I felt like I understood all of that. The franchise and the market domination, Constellation, same thing. But my problem here is, who the hell holds on for 50,000%?
Yeah, that's the hard thing, right?
It's really hard. Who does that?
They all have big drawdowns too to get there. There's a pretty famous chart I think Morgan Housel put together. If you held Amazon to get the big returns in Amazon, it was down 90% 3 or 4 or 5 times. Nobody can hold on through that.
Yeah, you could. And I thought was he the one who did if you bought it at the top of the .com bubble?
That's probably right.
Yeah. So I was like, oh yeah, that feels great for 5 years or 10 years, doesn't it? You're going sideways or whatever. It's really difficult to do that.
When you mentioned Walmart before, you said it doesn't have. Is it a change in Walmart's business, or is it the valuation that has changed your mind on Walmart? When did you like it? Like it was cheap maybe 4 years ago. I think it was really cheap.
Well, I liked it in. I think the first time was 2005. And I forget, I think we held into like 2016 or 17 or something maybe. I forget, we held it for a long time. It was like maybe even 10 years. But so Walmart, I feel like the thing that I don't understand with them is some of these capital allocation decisions, Flipkart and all this stuff. It just...
Jet.
I don't completely get it. I know what they're trying to do, but it just seems so haphazard, and it seems like they're paying so much. It's like the analogy I like here was made by a guy named Scott Galloway. It's like, $1 billion hair plugs for an old man who's trying to get girls again. It's not there. I'd rather have a better business model. I think is like Dollar General.
Yeah.
I think the dollar model is better. And the idea, too, part of the idea behind owning these things, and I think one of the reasons why they're making new highs, Dollar General and Walmart lately, is that in bad times, they find a lot of new customers, because people who used to shop at Whole Foods can't afford it anymore.
They're a little bit anti-fragile.
Yes, quite a bit, I think. So they both did the same thing, didn't they? They both went in, they started out going into the rural areas, serving the underserved customer with, everyday low prices or dollar prices, right? And then that model was able to expand into suburban and even urban areas now. And I think Dollar General has more, upside there than Walmart. And Walmart, they're so big that they've they've kind of gone around the world and experimented and had to get into and out of places like, Germany and I guess South Korea. They have to do that, and it's not always going to work. So
those big acquisitions are always, they're funny, aren't they? Because I remember distinctly when Google bought YouTube for $1 billion, and a lot of value guys made fun of, like, it was Chad and somebody else were the guys who, they look like, they were kids. They bought this thing for $1 billion, and everybody just said, what? They've just massively overpaid. They're clearly one of the greatest investments kind of made over the last 20 years or so. True also with Instagram.
Yep.
$1 billion just dropped on a website that wasn't making any money, and wouldn't you love to own Instagram by itself? Now, wouldn't you love to have made that investment? But then you got Walmart with Jet. I don't know if that's going to work out or not.
Yeah, it doesn't have the same mojo as YouTube and Instagram, does it? So there's a problem there with capital allocation. But I was an idiot. I thought Microsoft had the same problem, with Nokia, which I was like, oh my God, and there were a couple other ones they made there that they paid billions and billions for, and I thought, oh, jeez. But all they did was get rid of Steve Ballmer, and hey, that's all fixed. and the underlying,
transitioned the business.
Yeah, the underlying products were just continued to strengthen, and they developed new ones too. Their enterprise offering became substantial. It flew under the radar and then became substantial.
It was a very popular value stock in sort of 2011, 2012, something like that. I saw quite a few pictures at like Value Investing Congress, and it was kind of around on the internet a little bit. But it was one of the years where their revenue line actually declined a little bit for the first time. So you kind of had to be able to figure out, can this thing start growing again? But then of course they've turned it into a SaaS business, and wow.
Yep. Yeah. Amazing. And I missed a lot of that ride.
Well, it's tough, right? If you're looking at the quality of the business and you're trying to figure out what is this thing going to look like in the future, if you're not a little bit nervous by that revenue line taking a step back, and what else are you going to look at?
Yeah. When declining revenue is to scare the bejeebers out of anybody, right? There are no people buying declining revenues in foxholes or something. I don't know. It's difficult. But in that instance, we actually held on through that. We found it in 05. It was that 05-06 period. I went on what I called my world dominator jag, where I was buying stuff like, Walmart and even at the time ExxonMobil, I think, was one of them, and Berkshire and ADP became one of them in November of 08, and there were a bunch of those bigger ones. Johnson and Johnson became one. We had AB InBev for a while, because I thought, well, after a while, it was hard to buy value, toward the peak of the housing bubble, and then not too long after it. And those were it. Those were the things I was finding that people didn't seem to want as much around that time.
Well, how do you feel about now, the current market contrasted to that sort of late aughts period, just pre-2000, like that 6, 7, 8, 9, 10 period?
I think I like it better now than a lot of value guys, because we were down 30-odd%, or 34% in a couple of weeks or whatever, and then we bounced back so sharp. But for me, the more important thing is that I was bearish for 3 years, and lo and behold, it finally fell apart. And I feel like we're on the other side now. And on the leading edge of that, everybody's in love with equities. Everything just goes up and up and up. Every dip is bought. Everything's fine. Dan's wrong. Dan's an idiot. Being bearish is stupid. You can't, I had real trouble buying anything at various times. And now there's a lot more uncertainty in the world, and there's a lot less, certainty that everything is going to go up. Now, right at this moment as we speak, of course, people are becoming more optimistic because we've had this 20-odd% bounce really fast. But I still like being on this side of that peak a lot better than the front end of it.
Are you finding more opportunities now? I'm talking about after the bounce, not necessarily through the bottom of that
Sure.
trough.
Yeah, I mean we had a couple of things that they came up, and we recommended like one of them, and now they're not as attractive. But there are a couple more that I think are still pretty attractive. I don't want to say what they are because we haven't written about them yet in Extreme Value. And frankly, it's like week by week, how much is the market going to go up? Is this thing going to disappear too? So we're literally like, our next issue of the newsletter is due out in the second week of May, as you and I speak, in the first week, or not quite the first week, I guess. We'll ride out that first week. May 1st lies on a Friday this year. So we'll ride out the last week of April and right up to like May 1st and a couple days before the deadline that we need to publish, we are going to be in decision mode that whole time. And we're probably going to write up 2 or 3 things in rough draft and pray that one of them stays cheap enough. It's like that. It's day by day now. And I wish the environment would have lasted, but it didn't. So,
are you publishing? It's a monthly newsletter.
Yeah, monthly newsletter comes out second Friday of every month.
And do you have to recommend a new name every time, or can you just update the portfolio? What do you like to do?
I don't. I'm actually known in Stansberry as the guy who often doesn't recommend a stock if he doesn't want to, and it pissed readers off a lot of the time, but I think they sort of get it more now.
Do you publish the whole portfolio at any, does the newsletter contain the portfolio, shows what you own and kind of where you're holding it?
Yes, it does. It contains model portfolio on the back page. We are, to avoid, regulatory problems, I can't own the stuff I write about.
Really?
We're a pure research organization. And so it's a little difficult, but what I wind up doing is, to the greatest extent possible, I will own something as similar as possible, to whatever I'm recommending. If there isn't one available, I just have to skip it. And but that's how I've tried to do it over the years, and it mostly has worked. I think it's worked out a little better for the reader, thank goodness. But that's the best I can do to avoid being seen as as like a 40s Act type advisor.
Right. You've got one of the more interesting backgrounds in value investment. You're a rock star turned Spanish guitarist. Can you tell us that story?
Well, I was a classical guitar major in college. That's what I studied. I studied music. I have a degree in music from Towson University in Maryland. And I don't know. The weird thing about it was, like, even I remember one of my roommates asking me, isn't it going to be tough to make a living as a musician?
And be a value investor.
Yeah, that's right. That's right. And I said at the time I did say, I don't expect to be able to do that. I just can't live without knowing how to do this, without studying this. I can't not do it. So, and I've continued to do it, and I put the guitar down for over a decade. I didn't play really at all, but I picked it up in the past few years, and I'm having a lot of fun with it. I've decided, I've played all kinds of things over the years. I've played like musical theater orchestras, Grease and West Side Story and, all kinds of stuff like that. And I've played in, just the guitar player in the coffee house kind of a guy and various things, and even in rock bands when I was younger in high school and stuff. But now I just want to play, classical guitar because I realize not a lot of people can do that. And, I play some fairly sophisticated material, and I'd rather differentiate than just sort of be one of the mob. But I do still play electric a little bit.
How does that inform your investing, or you just use it to escape? Well, the differentiation sounds a little familiar.
Yeah. I'm convinced that it helps somehow, if only because I'm in my office. My music room is the room next door here. If only by just offering me a 5-minute, respite from having to think about other things, because music is it's a flow activity. When you're doing that, you're not doing anything else, right?
Yeah.
So that's good. Maybe it is the escape then, I would say. But there's something about it, like, I'm trying to learn some more, like Johann Sebastian Bach on the guitar. Very difficult material, but wonderful stuff. And there's a complexity to it, and there is a structure to it that underlies. And once there's so many notes that you can get lost in the forest among the trees, but when you finally learn a piece, you step back, and that structure becomes so utterly obvious to you. And truth to tell, it's more complicated than that. You try to do the structure first, and then you learn all the notes and get lost, and then you relearn the structure. But yeah, there's seeing that, being able to see the forest for the trees helps. It's another thing in life where you need to get lost in the details, just as you do with every stock you buy, in my opinion. You need to go bottom up, and yet when you step back, there is a stepping back point when you must look at it from the the 30,000 foot view. There's got to be a larger plan to what you're doing, and that's very stimulative to me. That's very I love that about music in general, is that details working out a larger structure. It's the typical thing to think about creativity is that you got a blank canvas in front of you and you can do anything you want. But the more creative perspective, the more creative situation is when you're kind of stuck in a place and you need to get out of it, or you've got a very specific problem that needs to be solved. That's the real creative thing. So learning to play the prelude from the Bach number 4 lute suite in E major, that's a very specific problem. You must play every note correctly. How are you going to do that? How are you going to work that out? Because sitting there and going note by note, that's just a non-starter, man. You're not going to get anywhere with that. So you must have an approach. You must have a process, or you will go loony shooting yourself in the head. Same thing with every stock you come across. It can't be a one-off thing each time. You must have some kind of a process, and it has to be a process that works, that you trust. I talked with James Montier about this very subject recently, and he has a chapter in one of his books, Process, Process, Process. It's the thing you can control, right? It's the thing you can rely on and control and lean into. And eventually the topic for investors, especially value investors the last 10 years, is how are you going to hold on when you're down 20, 30%? Well, I'm going to trust the process of knowing and having conviction that XYZ is a truly great business and has excellent long-term potential. And the downside in the business, regardless of where the share price goes, is limited by XYZ, the management, the balance sheet, the model, etc. And I've been tested that way with a couple of names, and I've stayed the course. And it's worked out. I think other people would have, just cut their losers and moved on, but I've stayed the course, and I think it's worked out well so far, and I think it's going to work out brilliantly, fingers crossed, over the next several years.
Well, how do you know when you've made a mistake through a process like that? How can you tell the difference?
Well, that is a one-off thing. You have to be very clear on what it is you're doing. In other words, if you're saying, well, this is a lousy business, but it's a net, and I think it's got real potential to be a multi-bagger, and then it goes bankrupt, well,
That's a mistake.
That's a mistake. We know what happened there. Or it just goes sideways for 20 years because it's a crappy business and nobody cares that it's a net. But with something that you think is a really excellent business and will be for a long time, you have to update this. You have to be very clear on why you think it's a great business. And that's not static. Why you think it's a great business means, what are they doing? And will they continue to be able to do this? And if not, what else can be done, if anything? So there's, you stick with something, it works for, say 5 years or something, and then there's a change. And you've got to be able to reassess. It's a brand new company, effectively, at that point. But I think that's how you get the big compounders over time. And I think Constellation Brands is a great example. And Prestige is a good one, too, because we got out of Prestige because we thought, well, these brands aren't as strong as they used to be. And in fact, at that time, I was going through a period where I realized the idea of a brand is different today than what it used to be.
That's good. I was going to ask you about that. Let's talk about brands a little bit. Why do you say that?
Well, again, it's the difference between this static view where you say, well, if it's Coca-Cola, that's it, I'm done with it, it's a great brand forever, and saying, where are they now? Where is this brand now? And for me, like I said, the idea of a brand changed from a label slapped on a product. I think the old school idea of a brand is advertising. You establish this identity through advertising, and then you take that awareness that you've planted in the customer's mind, and you've got to have a mechanism for shoving it in front of them in the grocery store and putting it on the end cap, the distribution piece. So it's storytelling plus distribution. Well, what the hell does distribution mean in the age of the internet?
Yeah.
I mean, like the distribution pipe is the broadband coming into your house. So Google makes a lot of sense now, and Microsoft makes a lot of sense, and et cetera, right? Facebook makes sense in that way. But maybe the compound wart remover doesn't, because now I can go on Google or Amazon, and I'm not looking for a name, am I? I'm looking for a benefit. And I want that benefit to come from the place that offers it for the lowest price. So all of a sudden, having that name, Compound W or whatever it is, it doesn't mean what it used to mean, where you're walking into the store and deferring to brand so that you can be assured you'll get the benefit. Well, now you can scour the earth from your desktop and find the benefit at the price you want to pay, at the lowest price, right? So to me, that's how brand has changed, and it has powerful implications. I think it has implications for value investors, because we talk about those deals, Instagram and stuff, and they look ridiculous by traditional metrics on the face of it. But then you think, well, how is this thing? It's the distribution pipe is the internet, and kids are already in love with it. People are already in love with it and can't be without it on a daily, hourly basis.
Right.
And that has to be kind of enough for you, and you have to understand how those things can be monetized.
I'm glad you raised Instagram, because I think that's one of the interesting features of Instagram is how good their ads are at targeting stuff that I like, particularly. And I've had this conversation with other people; they like the ads too. You can scroll through, and the process is different. Where previously you needed to go and find the thing that you wanted, and now you find the person who you trust, who just recommends these things to you that you like, and that's sort of that puts a lot more power in the hands of those influencers, I guess.
It does. It's game changing. It's instead of deferring to brand as you walk through the supermarket, you're walking through Instagram, if you will, and deferring to that individual, that influencer. Yeah.
And also Instagram's recommendation engine seems to be very good at, it knows the kind of clothing, for example, that I like, and it recommends this stuff to me all the time. Oh, that's pretty cool. I've bought stuff from Instagram.
Man, and I have to say Facebook too. Facebook and Instagram, they're right on me. They know what I want by the hour. I spend fewer hours on both of them now than ever.
I have to consciously do it for Instagram. I get a bit of an ick factor from opening up Facebook, but I definitely have to consciously do it for Instagram.
Yeah, I hear you on Facebook. I'm hardly ever on it anymore. There's something about it, and I think maybe ick factor is a good way to think of it. I just think of every time I open Facebook, it's funny, the same company owns it. Every time I open Facebook, I see Mark Zuckerberg in front of me, and there's something about the way they've run this company that rankles me. So
It's almost like we overshared a little bit for some period of time, and now I don't want to go back in and see all of that stuff that I overshared, even though I haven't put anything on it for years.
Absolutely, I'm ashamed. I don't want to.
That's what it is.
Go back and face it. That's right.
Whereas Instagram's a bit more passive. I don't really feel the need to share anything on Instagram. I'm just looking at all these other people who are sharing stuff on it.
Ditto. Yes, totally agreed.
Very clever. But then I live my life on Twitter because I really love. Twitter's a very interesting tool, and I think it's so funny that I think that Twitter's got a lot more potential than many of these other ones, because I think that Instagram's probably close to its potential, but Twitter seems to have just been. It seems to be terribly run. The ads that they serve me are just nowhere near what I want to look at. And I'm producing a lot of verbiage on that thing. They must have a pretty good idea what I'm about,
Yeah. Yeah, they could look through my profile and, read a week of tweets and be all over me.
You would think.
They're not. They're so not. I mean, I don't think they've ever tried to sell me, like, in my profile it says something about classical guitar or something. I've never seen a music product pushed at me on Twitter. Never.
They've started doing this, and one of the other funny things is there are 3 different experiences. If you're on twitter.com, that's one experience. If you use TweetDeck, that's another different experience. And then if you use the mobile version of it, that's a different experience again. There's many more ads on the mobile version, and they're all stuff that I have nil interest in.
I've noticed too the difference between the mobile and just twitter.com, where I mostly am. And the feed is different, but yeah, equally useless in terms of ad content.
I just wonder if Elliott can do something there. Elliott and whoever the big VC firm that I think they've each stuck in $1 billion.
Yeah. I don't know who they are either.
One of the bigger names.
Yeah, it's funny. I've never really seriously considered Twitter. Maybe if it gets beaten up again at some point.
Yeah, it's just hard to. It's hard on traditional metrics, the way that I prefer to look at these things, to even kind of assess the potential of the business or the valuation. It's just hard to get a bead on where it is, what it can do.
Right. That Buffety kind of bond with the coupon that grows idea. It was great for Coca-Cola in the day, but it doesn't translate to Twitter.
It doesn't Twitter. I do think it does for some. I think you can do it for Facebook. I think you can do it for Google, for
Absolutely.
Microsoft. I think you can do it for those ones. Twitter's almost still back to being a startup or something.
Yep. Yeah. Twitter is like we're for years now, for a decade
or more. Yeah.
We've all been sitting here saying they're gonna figure this out. They're gonna do it. They're gonna monetize in a big way. And I'm still looking at my watch and looking at the calendar and waiting.
And it's expensive. I mean, it's optically, it's still a big kind of expensive thing. So it needs to kind of do something. That's why it's just in no man's land for me. It's not cheap enough to do anything, and it's not good enough to do anything either.
Yep, it is. It's just out there in limbo.
I've enjoyed chatting to you, Dan. If folks want to get in contact with you, what's the best way of doing that?
You can find me on stansberryresearch.com, STANSBERRY research.com. I found out something recently. You can type worlddominators.com, and it goes to the extreme value part of the Stansberry website. And, somebody in the company like 10 years ago bought that name and stuck it out there, and we never did anything with it, at worlddominators.com. And it takes you right to extreme value on Stansberry's website. It's funny.
We'll throw links up to that in the notes. And you're on Twitter as well. What's your Twitter handle?
I'm at dferris1961.
Very good.
Or if you type Dan Ferris, I think that I should come up.
Well, it's been great chatting to you, Dan. Dan Ferris, editor of Extreme Value. Thank you very much.
Thank you, Toby. Always a pleasure. Anytime you want to talk, we'll talk often, I'm sure.
Pleasure's mine. Thanks, Dan.